What's going on, everybody? Thanks for joining me today. And today we're going to be talking about the exciting topic of rental properties and how you can really maximize your deductions and expenses on your rental properties. Before I continue, it would be great if you are new here, if you could please subscribe to my channel and smash the like button. That would be amazing, and appreciate you giving me your most precious resources, which is your time, and hopefully you find this video helpful. So as we move on, all the things I'm going to be talking about here are strictly related to business rental property. None, or maybe only a few of these things can be applied to your personal residence. So if you don't have any business rental property or short-term rentals or anything like that, please don't confuse this video to be applied to your personal residence. Okay, so all this is for business property, investment property. I'll start with the list of common deductions that you can take on your rental property. First and foremost, obviously being mortgage interest, which is what you pay on your mortgage if you have a mortgage on your property. Now remember, just the interest portion, not the principal portion. The next is property insurance, hazard insurance, property insurance, that can be deductible, as well as mortgage insurance premiums as well for those properties that have less than 20% down. I believe that's when you would be required to pay mortgage insurance on most mortgage products. The next obvious thing is property taxes. Property taxes are what you pay to the county in where you live in order to just have your property, and they probably use that taxes for improvements in your area, hopefully, but probably not. If you are a short-term rental person, they have Airbnbs or Vrbo rentals, then you will likely need to furnish your property with furniture and supplies, toiletries, and all that crap. All those things can also be deductible as well. Cleaning fees, maintenance fees, those things, again, also quite deductible, as well as management fees if you pay somebody to help manage your rental for you. Now, when it comes to repairs, this is where things get a little slightly hairy, because there's a difference between repairs and renovations. So repairs are things that something gets broken and you pay somebody to bring it back to where it was before it was broken, to the state that it was before it was broken. Whereas a renovation would be an improvement to the property. You renovate a kitchen or a bathroom or a basement or something like that. That would be considered a renovation, and I'll talk about that later. But really, repairs are all 100% deductible immediately. Some exceptions here: if you had to replace like the furnace, the actual furnace unit itself probably would have to be capitalized and depreciated over time. But because of bonus depreciation and Section 179 depreciation rules, you probably can take the full expense in the first year anyway. Now let's go to the lesser known deductions that people may not consider, or maybe they do, but they're just not sure. And the first one being travel. Now, if you're somebody who has investment property, you may have some out of state, or you may be interested in acquiring property that's out of state or far away from where you live. And so traveling to those areas to either research property, look at property, or if you already have property out of state, if you travel there to just check on the property or maintain the property or whatever, that expense is all deductible. Now, travel can get hairy if you mix personal with business in the same trip. So, let's say if you live in Colorado like I do, and you have property in Florida, and you want to go and check out that property, maybe look around for more property to acquire, you can definitely deduct the airfare there and the lodging, and all the meals that you incur, the rental car, all that stuff would be deductible. All right, and let's say you go there for just a few days, that's a-okay. Now, if you wanted to go there to check on property for a few days and spend a week at like Disney World area and kind of hang around at the beach and all that crap, then that's when things get hairy. And that's where the airfare can still be deductible because you needed the airfare to get to Florida. The lodging and the food and the car rentals on the days that you did conduct business are also deductible. Now, on the days that you just spent at the beach or at Disney World, the lodging and car rental days for those will not be deductible. So those will just have to be kept as a log to separate them out for the IRS in case of an audit. If you live in the city like me and have rental property up in the mountains, and you don't have somebody managing the property, but you're the one that does all the maintenance and all that crap, if you drive up to the mountains to do repairs and maintenance and checkups, that mileage could be deductible. And it doesn't even have to be the mountains. Anywhere you drive to your property to do maintenance on or repairs on, if that's what you do on your own, the mileage to and from that property will be deductible. Now, if you have real estate, you're probably familiar that if you eventually sell that property, you're going to have to incur capital gains because typically real estate appreciate in value. Residential real estate just simply appreciates over time. So the appreciation of value would result in the capital gains if you bought it for X 1 year and then 5 years down the road it's worth 1.5x, let's say. So that 0.5x difference becomes a capital gains. Now, if you're still interested in being involved in investment properties, what you can do is do something called a 1031 exchange, where you basically trade one property for another property, and in that case, you don't have to realize the capital gains at that point. You don't actually get rid of it; you just defer it to a later time. And this could be an effective strategy if you always are interested in being involved in rental properties and investment properties. You can keep deferring the capital gains until you die, and then whoever inherits your properties will have a huge tax advantage if it was set up properly. A good way to just avoid capital gains tax throughout your life, if that's something that you're really into. If you're not really into keeping up with the actual tasks of maintaining a rental property, you can 1031 exchange your current investment into a Delaware statutory trust, which is not something I'm going to talk about in detail in this video, but something I can talk about more if the demand is there. And the last kind of lesser known strategy that I'm going to tell you about is called a cost segregation strategy. And this allows you to take more of an expense on your rental property up front rather than depreciating that cost of the building over 27.5 years. But this strategy only is worthwhile if you are considered a real estate professional or if your rental activity is considered a non-passive activity, and I'll talk about that next. So why do you have to be a real estate professional, or why does your rental activity have to be considered non-passive for cost segregation to be worth it? Well, if you have rental investments and you have like a regular job as an engineer or something, and you just have a few side properties as rental property investments, those rental activities are considered passive. And if you happen to have a net loss on the rental activity that you have, which means you have more expenses than revenue, that net loss can't be offsetting your other sources of income. In another example, let's say you had a side business where you run like a little coffee shop or something, and that coffee shop reports a net loss at the end of the year. That coffee shop net loss can actually offset your other sources of income and reduce your income. And that's because that is active income. You're running this business, right? But for a rental property, for most people making $150,000 or more, there is something called passive activity loss limitations. So what that means is if you have like a big W-2 job, you and your wife, and let's say you're making $200,000 a year, and you have a few rental properties on the side, and those rental properties consistently generate a net loss, well, you can't take that loss against your W-2 earnings because of the passive activity limitations. In order for huge expense strategies to make sense on your rental properties, you need to be able to qualify for active participation or to qualify as a real estate professional in order to really capture those net losses against your net income. So why is that important for cost segregation? Well, first let's talk about what cost segregation even is. Cost segregation is the study of your actual property building and breaking it down into different components so that you can take more accelerated depreciation on those certain components more quickly. So when you buy a piece of real estate, you buy a house for investment, you can depreciate that cost of that building over 27.5 years, which is just a normal accounting thing that you have to do. But if you did a cost segregation study on it, it's going to break down some components of that building into the 3-year property, 5-year property, 7-year property, and 15-year property. So 5-year property might be like the baseboards and the framing, the drywall, and all that crap. That stuff can actually be bonus depreciated and Section 179 depreciated immediately, rather than having to take those costs over 27.5 years. So generally, we might see 10 to 20% of the cost of the building able to be depreciated right away in the first year, which is pretty extreme, right? You have a $500,000 building, a $500,000 home that you bought, $50,000 to $100,000 of that could be immediately expensed, which is a huge benefit. Now, like I said, it's not a huge benefit unless you have active participation qualifications in rental activity or you're a real estate professional. Otherwise, that benefit will just be stored away and you won't be able to use it until you sell the property. I hope that all makes sense. I might do another video more specifically on cost segregation and how that works and how that applies to rental properties and other commercial properties that could be beneficial. But for now, hopefully this short video on how to take, be more aware of the things that you can take advantage of for your rental property helps. All right, that's all I got for today. Thanks for joining me. Again, if you're new here, please consider subscribing to my channel, and I really appreciate you giving me your time today. I hope you found the video helpful, and I will see you all next time.
They act like they know. Guess I gotta hit them with the update. Okay. I've been getting to it when I'm up late. Hit it when you went the front gate. They act like they know. Hold up. Guess I gotta hit them with the update. Really with it, I ain't got a pump fake. Killer flow and hit them with the one take. Act like they know. Guess I gotta hit them with the update. Okay. I've been getting to